Hi, everyone, and welcome back to a new edition of Market Insight. And I am joined by my colleague and friend, Ted Bauman, editor of the Bauman Letter. Ted, welcome.
Hey, Jeff, how are you doing? I'm
I'm doing
speaking to
great.
you. Yeah,
And I imagine you're doing okay as well. You're talking to us from South Africa, correct?
that's correct. I'm in my home in Cape Town at the moment. I've been here for about 10 days, and I'll be here for another 3 weeks, my annual pilgrimage.
And it's very apropos since we want to talk this week for everybody about the opportunities that exist these days to invest in emerging markets, and they are great opportunities. I know you share my opinion. We'd also, for all of you listening to this, we'd like to hear from you. What do you think, and what do you believe about now being the time to invest in emerging markets? So make sure to leave your comments in the space below this video. So Ted, let's get right into it. I mean, obviously, you believe, as I do, that emerging markets in general, and you have some specifics in mind, as I do as well, that that is the place to really invest your money these days and take advantage of opportunities that the rest of Wall Street is not yet seeing.
Well, absolutely, Jeff. And I think one of the key things is that just from a strictly mathematical perspective, when we have valuations as high as they are in the United States in particular, there's a limit to how much higher they can run safely. But emerging market valuations are much more in line with the actual performance of emerging market economies and companies, which means that they have a lot of room to grow. So leaving aside questions of analyzing the health of the emerging market economies and all that, just from a purely mathematical perspective, they're coming off of a lower baseline. And so it's a given that the biggest growth has got to come from these economies going forward.
I agree, and it's one of those things. It's one of those dichotomies, if you will, that we all run into as investors and as editors. People recommend stocks that frequently, everybody's chasing after high-flying stocks, and they're usually chasing after it because everybody else is chasing after it. It's the popular thing to own. Owning stocks in emerging markets is not popular, and therefore it makes them cheap, under-owned, and obscure to a degree. And that means there's a lot less risk in owning them because when the tide turns, everybody's going to be fleeing out of larger stocks, the big ones, the biggest ones in this country that have really run up the market indexes, and they're going to look for value like you just said. And Ted, I just wanted to get your comment here. Like I was looking at where the fastest growing economies are, and just looking on a basic GDP website here, I'm noting Ethiopia has the fastest growing GDP in the global sector right now, 7.7%. And just below that is two of the largest economies in the world, China and India, also growing at roughly 7.5%.
Yeah, no, absolutely. And I think, again, this goes back to the question of the baseline that you're starting from. But the critical thing for investors is to be discerning about which countries you look at. And a country like Ethiopia is actually a good example of one that is growing quickly, but also has good fundamentals. In other words, it's not over indebted, it's not over borrowed, it's not subject to potential currency crisis, it's not likely to suffer severe downturn if there's a contraction of credit in the global economy or the US dollar rise in value. And so the critical thing is to look for countries that are growing, but are growing in a healthy way, and there are plenty of them. In East Asia as well. I mean, Vietnam is one that is attracting a lot of attention because of its own strength of its manufacturing economy as it grows, but also because that's where some Chinese operations are relocating to avoid tariffs. So one doesn't have to, choose an Argentina or a Turkey that might have a lot of currency risk and whatnot. There are plenty of safe havens where you can make a lot of money if you're discerning.
Ted, let's talk about what has been holding back investment in emerging markets to date, why these stocks are so beaten down. I believe part of it's just the generally unsettled nature of global trade right now because of the Trump administration and the concerns regarding what the trade status is with China. And of course, there have also been trade situations that have arisen between the U.S. and Europe, U.S. and Japan, and many other traditional trading areas around the globe. And I think that's just holding back investment, and it's creating uncertainty. And as we both know, Wall Street and investors in general do not like uncertainty. I think as these things are cleared up, and they are being cleared up bit by bit, I think we will see, and are beginning already to see, more investment flows into the sector. What's your thought?
Well, they always say that generals are fighting the last war, and I think that's kind of what's happening with investment sentiment towards the emerging market world. The nature of global supply chains has changed enormously, even since 2008. And there's this kind of residual notion that emerging markets are dependent on the performance of the advanced markets like the US, the Eurozone, and of course Japan, and of course then also dependent on China and its manufacturing supply chains. But as I pointed out in one of my daily articles a couple of weeks back, what's emerging now are supply chains that cut across emerging markets, where countries are trading with each other, and where they're not as dependent on demand from countries like the US or from the Eurozone. So for example, here in South Africa, there's a tremendous amount of trade between this country's manufacturing sector and countries like Indonesia and Thailand and Vietnam and so on. And this is an independent set of economic activities that doesn't depend on what's happening in the developed world. And that's different from where it used to be. So I think to the extent that people are discounting the emerging markets, they're doing so on the basis of a model which probably no longer applies.
I agree. And we also have to remember something that obviously is on everybody's lips in this country in terms of e-commerce, which practically dominates so much of what we think and talk about these days. But e-commerce is growing even faster in so many of these emerging markets. In Indonesia, I remember a few years ago seeing a statistic relating to 2 years ago when the data had come out, that in Indonesia, e-commerce grew in 2017 roughly 70%. In Mexico, it's growing similarly by high double-digit rates. And that's pretty much the case all around the world as these faster 4G connections, which we take for granted here, are coming to the fore in some of these other emerging markets that haven't had the luxury of faster connections. We all know what happened in this country between, say, 2010 and now as 4G mobile phones became commonplace. And this is still something that's coming out in so many of these emerging markets, which I also believe will lend to a huge explosion in the markets and the opportunities for investment there. Ted, one thing that we've seen obviously for many decades is that when we talk about like the Federal Reserve, emerging market stocks tend to do better as the Federal Reserve is cutting rates. And I'm curious what your viewpoint is regarding the Fed, which obviously there is a lot of speculation on Wall Street that they'll either embark on rate cutting or at least the discussion of maintaining a stance of cutting if they really feel like the U.S. market is truly weakening.
Well, a couple of things. First of all, I think, yes, you're right that emerging markets tend to do well when the Fed is cutting rates because it makes the yields on their sovereign bonds and their corporate bonds relatively more attractive, which leads to an inflow. The second thing is that I think definitely we're looking at probably a rate cut this year in the U.S. because the elephant in the room is weak earnings. We're right in the middle of a discussion in the press now about what's likely to happen. 80% of companies have reported that they're likely to have weaker earnings than previously. We've seen skyrocketing stock buybacks again this year, which means that corporate executives are not in the mood to invest in their companies, which suggests that they don't have a lot of confidence in it. So all those things tell me that the Fed is probably going to cut. And if they do, that means that that's going to be good for emerging markets. Now, one example, which we're seeing already, it's not exactly an emerging market, but I visited Greece recently. And while I was there, I learned that that Greek bonds, the yield on Greek bonds has fallen almost to the level of German bonds. Now, if you remember in 2008, the Greeks couldn't sell their bonds for love or money. But what's happened is that because as they've turned around and as investors have looked for yield, they've piled into Greek bonds. And the people who had invested in them have made a killing. I think it's a 35 or 36% since the beginning of this year on Greek bonds. The Greek stock market is up nearly 40% since the beginning of the year, 3/4 of that since the beginning of June. So, if you pay attention to what's happening in the rest of the world, you can really make a lot of money, but you have to pay attention.
Ted, I know a handful of the stocks, the ETFs that I would suggest people look at is one that I've written about a lot is just the iShares Emerging Market ETF. The symbol is EEM. That's just an easy way to play this sector in a very broad, lower risk sort of way. I like opportunities in Latin America, like for instance, Chile's economy is currently somewhat depressed because, again, related to these uncertainties regarding China and the US, because Chile supplies a lot of commodities into China's economy. But as these things become less uncertain, as the trade situation improves, Chile's economy will improve, and the stocks are trading at bargain basement levels right now. I also like Mexico, and that symbol for the iShares ETF there is EWW. Brazil is also a good place. There are lots of reforms, economic reforms going on there. That symbol is EWZ. What kind of ETFs do you like, would you suggest for people to consider?
Well, I think EEM is a good starting point because it has exposure to the entire market, and the way that they manage it is they bring specific countries' stock indexes to EEM based on their performance. So they're dropping out the ones that are having problems and they're bringing in the ones that are doing well. But one that I particularly like, again, not an emerging market, a re-emerging market, is Greece. And the ETF I like there is GREK. It's basically the main index on the Greek stock market. And again, it's up nearly 40% this year, quite a bit in the last 6 or 7 weeks. There's still got some room to run. Just also on your Latin America, I agree wholeheartedly there. And in the news recently, I noticed that the Mercosur countries, which are Chile, Argentina, Uruguay, Paraguay, and Brazil, recently concluded a comprehensive trade agreement with the European Union, which means that they're going in the opposite direction of the rest of the world in terms of harmonizing trade, opening up opportunities. So they are going to do better than everybody else in the next while because they are strengthening their trading position while everybody else is tearing it apart.
Ted, final thoughts here. Again, why invest in emerging markets, just to kind of wrap things up from your perspective?
Well, I think, as Wayne Gretzky said, you skate to where the puck is going to be, not to where it is. And, essentially emerging markets are where growth is going to happen. These things do go in cycles, but the critical thing is that right now we've had 10 years where the U.S. stock market has sucked in all the oxygen in the room. But remember, that's just the stock market. Eventually, you have to have economic growth. And economic growth is fastest in countries that are growing in population, that are growing in economic development, and that's the emerging market world. So almost from historical logic, you want to be invested in the emerging markets.
I couldn't agree more. And to kind of just summarize it, emerging markets and the individual stocks in them are unloved, undervalued, unwanted. To me, that's a great recipe for future gains. Ted, I really appreciate you coming on to Market Insight and giving us your thoughts.
It's a pleasure. Always good to talk.
And for everyone, thank you for joining us on this Saturday Market Insight. Don't forget to subscribe to our YouTube channel and make sure you tell us your opinion. What do you think about investing in emerging markets? Remember, we'll have a brand new edition of Market Insight next Saturday. So make sure to look for the reminder in your email. And on behalf of Ted, Brian Christopher, Ian King, Mike Carr, and all of us at Sovereign Investor Daily, thanks for watching.